Being called the South Korean Amazon obviously puts you in a category of high expectations. Now, Coupang, over the last couple of months, actually, since it went public, hasn't really been given that much love. More recently, the stock actually reached, I think its all-time lows at around $13, $14 or so. But yesterday, Coupang reported yet another quality earnings report. Profitable growth, better than expected results, resulted in the stock being up around 5% when the market opened. Market cap of just over $30 billion with a forward PE of 45 times. Now, if you look at what the analysts are expecting for the coming fiscal years, they are expecting 44.23% year-over-year growth when it comes to EPS, and then in fiscal year 2025, another 71.59% growth year-over-year, with sales numbers growing at 16 and 10.5% respectively. Now, despite all of that, as you can see here, before the little jump we've got right now, the stock would have been up around 15% since last year, despite it being performing quite well. It's growing and it's growing in a profitable way. So what are we missing here? Is it purely because this is not a US-based company? Is it purely because it gets associated with Chinese companies, despite it being a South Korean company that, yes, is also operating a little bit now in Taiwan? Is that why the market, let's say, undervalues this company? Could be. I'll show you the numbers and maybe you can make your case down in the comment section below. Before I continue, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, we really appreciate that. Want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So I'll start off with a couple of comments from the CEO. Our accelerating growth in revenue, active customers, and WOW members reflect our unrelenting focus on creating WOW for our customers across selection, price, and service, a bit like Amazon Prime. This year, we provided a record $3 billion in benefits and savings to our WOW members, providing relief amidst high inflation. Customers are increasingly turning to WOW membership for its unparalleled value, from exclusive discounts on retail products and eats to free down delivery to unlimited play content streaming and so much more. Again, you can clearly see here why this has been linked to being the Amazon of South Korea. The CFO ends by saying here, as we look towards 2024, we are more excited than ever about the opportunity to continue delighting our customers and driving long-term shareholder value. Now, I want to touch quickly on a couple of things that were mentioned during the earnings call, more specific one with regards to Taiwan and the other one with regards to the acquisition of Farfetch. So first up, with regards to Taiwan. Since launching Rocket in October of 2022, Taiwan's customers and revenue have continued to compound at an incredible rate, more than doubling over the last 2 quarters alone. It's a pace of adoption and growth that exceeds what they've experienced in Korea over the same period of time after the launch of Rocket. In Taiwan, we're able to leverage the advanced technology, learnings, and processes, among other assets, that we've developed for many years. We expect that to enable us to reach profitability in Taiwan faster than we did in Korea. Of course, for the overall business, this is hitting them on the profitability side of things currently. Then, with regards to Farfetch, while we weren't seeking an acquisition, we came across a rare opportunity to buy a sector-leading service with $4 billion in GMV for a $500 million investment. We hope in a few years we'll be having the conversation about how Coupang turned Farfetch into a business that transformed the customer experience around luxury fashion while also providing strategic value for Coupang. It's too early for that conversation today. Even if that full potential is not fully realized, we're highly confident that this will prove to be a prudent financial decision. We're already executing on a plan to make Farfetch self-funding with no additional investment beyond the announced capital commitment, and we see many paths to making this a worthwhile investment for shareholders. Again, $500 million for this type of business, in my opinion, was a steal. And while we're excited about the long-term potential of such investments, we remain focused on our biggest priority. We have a very small share of the retail markets in Korea and Taiwan. Each of those opportunities are massive, and capturing them remains by far our greatest prospect and priority. This is great to hear, especially because we've seen previous companies make acquisition and suddenly switch the vision because it looks fancy schmancy. No, they remain focused on their main mission, their main market, an extremely profitable market for them as well. Korea, of course, Taiwan still unprofitable, but growing quite fast. Now, jumping into the earnings presentation here, active customers increased 16% year over year. So of course, the, let's say, bearish points of them already operating in a highly saturated market, reaching their peak, growing 16% year over year is quite something. WoW members actually increased 27% year over year to 14 million. Then if you look at total net revenue, that's up 23% year over year, or 20% year over year on FX neutral basis, would have been 940 basis points higher without the FLC accounting change, reaching $6.6 billion for the quarter. With regards to operating income, that's up 57% year over year to $130 million. Net income is up $930 million year over year to reaching $1 billion. Of course, close to $900 million of that was from a tax reserve adjustment. If we look at gross profit, also major improvements there year over year, up 32% year over year. Gross profit margin up 160 basis points year over year to $1.7 billion and 25.6% margin. As for adjusted EBITDA, that's up $83 million year over year with a 4.5% margin, up 50 basis points year over year. A 50 basis points year over year improvement is quite something, but they say here that would have been around 40 basis points lower without the FLC accounting change. Now here you can see revenue and adjusted EBITDA from their different segments. So one is the product commerce. This is in the trailing 12 months. You can see great growth, profitability is improving here as well. But if you look at the developing offerings, yes, growing quite fast when it comes to net revenue, but adjusted EBITDA, this is the one part that is still hitting this company when it comes to margins. Now looking at operating cash flow and free cash flow, this is trailing 12 months metrics here. Operating cash flow is up $2.1 billion year over year. Free cash flow is up $2 billion year over year. In my opinion, this is just the start of seeing something quite nice developing. With regards to the long-term opportunity, they see product commerce adjusted EBITDA margin, long-term target over 10%. Now it's at 6.5%. Consolidating adjusted EBITDA margin currently at 4.4%. Same thing here, long-term target over 10%. And to finish it off, just to show you the growth rates when it comes to active customers. In Q1 2023, that grew 5%, then 10%, then 14%, and then we're now at 16%. This is why it's very important that their offerings is the best in class. It's the same thing here with Amazon Prime. Why is that so popular? Because it is the best in class. It is the best subscription, in my opinion, that is out there in the market. You get content, you get free deliveries, you get promotions, Twitch, probably some other things as well, depending on where you're located. But again, when you offer best-in-class service, usually you attract more and more users. Once those users are in your ecosystem, you can start monetizing them more and more. And since they are playing quite a big role in South Korea, you can say this is a niche market. It's a pretty big market, especially in the e-commerce space and especially in the luxury space as well. They're not focusing on expanding in Europe or in South America or in Africa or in North America. No, they're very, very focused in what they know best. Yes, they are expanding now to Taiwan, growing quite fast there, but that's about it for now. Very, very smart strategic decisions. Now, looking at the stock right now, to be honest, I didn't even know this was trading at under $13. Too bad. I would have liked to trade this a little bit, but okay, you live and you learn. I'll definitely put this on the watch list. But right now, we can see that over the last couple of weeks, this stock has been going up and up and up. We're now well over the 200-day moving average with SIX at $16.38. Today, the stock is up 7%. If we look at the daily, we can see that the stock tried to go over $18, didn't find that many buyers there, so went under it yet again. Right now, $17.55. If we look at the past here, we can see that, $18 or so was a previous resistance already back in May of 2023. We can see this here also in October of 2023, so definitely that is a resistance point. Plus, if you look at RSI is overbought on the daily. So to conclude, in my opinion, Coupang is still flying under the radar. You're buying here a very, very strong business, a growing business, and a growing business in a profitable way. Plus, you're not really paying that much extra for it compared to other valuations that we've seen in the market, even Amazon, for example. Of course, Amazon, best in class, plus you get AWS and a huge advertising business as well. But looking at other e-commerce players around the globe, I mean, we've seen valuations much higher, and some of them aren't even as profitable as Coupang. So in my opinion, yes, Coupang deserves to be on a watch list, and maybe some of you already own it or are ready to buy it. Do let me know down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.